All right, good evening, ladies and gentlemen. Welcome back to episode 16 of the Australian Goldbeat review. Thank you so much for all your engagement so far. It's been quite a crazy week for gold this week round. Seen an absolute roller coaster ride, and this series, as usual, is going to cover those moves in gold, silver, oil, as well as the ASX Gold Index. And we are also going to have a members only section for this video as a part of the series, which if you would like to watch, all you will have to do is go to the Gold Hub Australia website and sign up for a free membership. It takes only 5 minutes, and you'll be able to watch the member section of this video as well. Apart from that, as usual, we've got our managing partner in Gold Hub Australia to uncover all the insights for you this week, Mr. Brian Chu. How are you, Mr. Brian?
Yeah, I'm doing okay, Van. Actually got a bit of a allergy problem from the past few weeks. Again, excuse me if I do get a little bit of sniffles.
Yeah, that shouldn't be an issue at all. And so, as we said, it's been quite an insane week for gold, and not just the precious metal in itself. We've got explorers and developers showing significant movements as well in both directions, positive and negative. And we've also got major producers emulating gold to a certain extent. So looking forward to having this discussion with you, Mr. Brian. And without any further ado, let's get started. And as usual, starting off with gold. So the price of gold this week closed at US dollars 4,085 an ounce, which is a 2.07% increase this week. So the 2.07% move looks like a classic consolidation leg inside a much bigger 2025 breakout as we've seen this year. We're coming off that parabolic run where gold burst through 4,000 US dollars. It records above $4,300 in October and is now up close to 60% year to date, which is helped by deep concerns about US debt, currency debasement, and record central bank buying. And we've been quite vocal about that on our X or our Twitter page. So if you would go to our X account, you will get to see a lot of replies to several content creators and tweeters about gold and silver. In the week, though, the main driver has been the growing market conviction that the Fed will cut rates in December after the data backlog from the US shutdown, which has pulled real yields and the dollar lower and kept ETF inflows positive. At the same time, big houses like JP Morgan's openly floating US dollars 5,000 targets are feeding that reflexive fear of missing out bid, even as some analysts warn we're edging into bubble territory. We've also added our opinions about the 5,000 US dollars an ounce price tag, stating that we're not sure about the 5,000 mark in itself, because that seems like a far stretch. But as far as we talk about structural forces and talk about the macroeconomic demand as well, I think gold in the medium and long term, by the end of 2026 at least, is set up for, I would say, quite a substantial bull run. What do you think about that, Mr. Ryan?
It's interesting you mentioned the US $5,000 milestone, because I've got a few relatives that are over from Hong Kong, visit us the last 2 days. And last night over dinner, one of my uncles, who I was actually surprised that he's been investing in gold and mining stocks, but because he's from Hong Kong, he invests more in the China-based companies. He actually asked me, do you think that we will see 5,000 US dollar gold? And I said, yeah, we will see it. I don't think we'll see it by the end of this year, but next year, that's a higher possibility. And it was worth mentioning that same time last year, in November 2024, gold already broke above 4,000 Australian dollars an ounce, and in US dollars an ounce, I think it was about 2,700, 2,800. Now, 5,000 US dollar gold, in my view, if it happens quickly, is actually not a good thing. And I've mentioned this a couple of times in my writing to my newsletter readers in Fat Tail Daily and also the paid subscription newsletters. and I have also vocalized this in a few places myself. If gold goes up quickly, that's a sign of rising inflation, loss of purchasing power, and unless you own 1,000 ounces of gold, you're not going to benefit from that. And therefore, all that talk about, oh, are we going to see 5,000 US dollar gold soon? I always go back and say I say the statement, be careful of what you wish for. And as you have mentioned, Ved, that there are economic undertones that may support gold rising further because of the government deficits, central bank borrowing, and also expectation of rate cuts. That's bullish for gold. But if all this happens a bit too quickly because of economic weakness, then very few people are going to benefit from it. And even our viewers here in our channel, even though they're gold enthusiasts, I don't think there's a large proportion of them who would like things to happen. Always suggest that people temper their expectations and always be realistic about where things are heading.
Right, that's a great response. Thank you so much for that, Mr. Brian. And now let's move on to silver.
So silver has had quite the week, and when I said it's been a crazy week for gold, it's been an even crazier week for silver. And I think the closing price doesn't do justice to silver's story this week, because silver closed at US dollars 50.53 this week, which is a 5.37% increase, but it's seen a high of 54 US dollars this week as opposed to $48 an ounce last week. So this jump is a classic high beta behavior in comparison to gold, but there's more going on under the hood because silver has broken into the low 50s and then spent the week consolidating just above key support in the low US dollar 50s, with several technical commentators framing this as a constructive pause after a breakout above 54 US dollars. So structurally, the market is increasingly treating silver as a strategic industrial metal and not just poor man's gold, because we've seen demand from solar, EVs, and electronics increasing at record levels, while multiple forecasters keep flagging persistent supply deficits through the mid-2020s, especially in Asia. And in Australia, all the more as we've seen the US and Australia assign their critical metals strategy. And if I'm right, I think silver has recently been recognized as a critical metal after the signing of that deal between the US and Australia. So that's what gave silver the extra torque over gold this week. However, there are early warnings from desks like TD that mine supply growth could make the market vulnerable to sharp pullbacks if speculative longs get crowded. So what's your take on silver's movement in relation to gold, Mr. Brian? And how do you think the fund is positioning for this specific metal or miners that deal with this metal?
So a lot of people look at silver and they associate a rising price of silver to mean that silver mining companies are going to do better, or that holding physical silver is beneficial to them. But having done quite a bit of data research on the relationship between the price of silver and gold mining stocks, and yes, I haven't, it's not a Freudian slip, it is gold mining stocks. Silver is actually more correlated with gold mining stock movements than gold actually is. So when I look at the rising price of silver, especially in the way it did this week, that silver rose more than gold by percentage terms, gold mining stocks, the index actually went up significantly. And only on Friday did we see in the Australian markets, gold stocks actually pulled back quite significantly, despite gold actually doing better. But then what was very interesting, and we will visit this a bit after when you talk about the gold stocks, the reverse actually happened in US trading. Gold and silver pulled back, but the GDX, the GDXJ, and the HUI, which are all gold stock indices in the US and the international markets, they dropped heavily during the open of the Friday trading in the US, and it spent the rest of the day rising. So there are significant implications of where that is going. But with silver rising above 50 and managing to hold it for the week, that's why I've been bullish about gold stocks and the Australian gold fund portfolio. In these last month, in the correction, we actually reduced our exposure to precious metals ETFs and increased our exposure to gold stocks, but more on the smaller companies. And in the recent week, especially with the bounce, we actually continue to increase our position on some of the developers and near-term producers, a couple of which had pulled back heavily during the last month, but they've actually started to rally quite a bit. So that's been good news. And a few examples, not financial advice, of course, it's including Horizon Minerals, Bright Star Resources, Nova Minerals, James Bay Minerals, and also we had added a little bit more on Nexus Minerals.
All right, thank you so much for that, Mr. Brian. And that's an interesting correlation that you've put up about silver being more correlated than gold to gold mining stocks. And we will discuss that further in the member section of our video. However, moving to oil for the moment, it's remained flat this week as it closed at US dollars 59.94. But early in the week, it decreased to US dollars 58 per barrel. So early in the week, prices sold off hard as OPEC's latest report and follow-up commentary confirmed the possibility of a meaningful surplus in 2026, as we all know. And US inventory data showed a much larger than expected crude build, and that surplus story was reinforced by the IEA, which now projects an even larger global glut by 2026 as non-OPEC supply grows faster than demand. However, moving on to the ASX All Ordinaries Gold Index this week, it's back to normal. So we've seen the ASX All Ordinaries Gold Index at 17,119.19 points, which is a 1,180.82 point increase. And despite seeing only double-digit increases for the last 2 weeks, seeing 1,180.82 still feels like a low increase simply because of the mania that we've seen in the preceding weeks, where we've seen 1,500 point increases, 1,700 point increases, and even 2,000 point increases during the week. So in relation to that, this still looks moderate. However, in terms of magnitude, it's still quite a high magnitude, as the ASX All Ordinaries Gold Index has doubled from its 52-week lows as Australian gold names respond to the global gold breakout. So putting aside the spread on purchasing ASX All Ordinaries Gold Index ETFs, as well as the brokerage costs, investors have made approximately 100% return year to date on the ASX All Ordinaries Gold Index now that it's crossed 70,119 points. And that, as I said, is obviously putting aside the spread and brokerage costs associated with buying the ETFs. However, the move has been broad-based. Australian market reports through the week kept highlighting gold miners alongside lithium names as key sector leaders on the ASX, with stocks like Northern Star Resources and Newmont Corporation advancing as investors look for operating leverage and reserve growth to monetize US dollars 4,000 plus gold. There's also a clear rotation into developers and higher beta explorers in the ASX All Ordinaries Gold Index, as we just discussed previously, as global and local funds search for catch-up stories, even as the larger producers start to look stretched on traditional valuation metrics after such a big run. And it seems like Mr. Brian already has something to say. So what would your comments be on this, Mr. Brian?
So I remember that about 3 weeks ago or a month ago, we saw the ASX Gold Index rise about 1,500 points, and it made records at about 17,900 points. And then even last week in our recent catch up, the ASX Gold Index was 15,398 points, something like that. It closed at near the lows of the correction. Except what's really positive about this week is that the gold stock index actually bounced quite a bit. Now, if it wasn't for the pullback on Friday, we would have actually been close to the all-time highs once again. And it's amazing that within 1 month, we had the sharp correction of about 15, 17%. And we're back near the all-time highs. Now, noting that gold and silver actually ended the week lower in US trading, but the US and the Canadian gold indices actually ended the day close to the opening after coming down significantly. I suspect that this might actually be a test on whether gold probably found its recent lows at 4,000 US dollars an ounce. I remember that in the last month during the correction, I said that I was expecting gold to correct heavily and possibly to 3,800 US dollars an ounce. We also have tech stocks pulling back. Michael Burry apparently had spent almost $1 billion shorting the tech stock market in the past week and a half, and he's reversed the trade. So chances are perhaps the market is turning around, and that might favor gold and gold stocks. But as I keep saying, in these times, there's a lot of volatility. There's a lot of uncertainty. So it's not wise to get stuck in one viewpoint and therefore putting your portfolio fully in that position in order to potentially benefit from one side of the trade without actually hedging your bets that you could be wrong because of the volatility in the markets and how quickly things can change at the drop of a hat.
All right, thank you so much for that, Mr. Brian. And we've got a further conversation on the ASX All Ordinaries Gold Index coming up in the member section only, and that we hope you've got some information to sort of soak in and use as a part of your investment journey through this section. And we'd like to remind you that none of the content that we've discussed so far qualifies as financial advice. And we recommend that you seek a licensed expert if you're on the outlook for financial advice. And with that being said, let's move on to the members only section, which, by the way, yet again, guys, if you want to watch, just go up to the Gold Hub Australia website. It takes 5 minutes to register for a membership, and it's absolutely free of cost. And so you will get to see the members only section, which has an even deeper insight into everything that we've just discussed so far, with a specific focus on a few producers.